Rental real estate is not about cash flow. At the end of this video, you're gonna know more than 99% of people when it comes to the real value of purchasing rental real estate. When I first got started, I was a big proponent of working as hard as I could and trading my time for money. I was probably just like you, working my ass off, slaving away in the minor leagues, making absolutely no money trying to make it to the big leagues. I read a book in 2015 called Rich Dad, Poor Dad by Robert Kiyosaki. You probably heard of it, you probably read it. It completely changed my mindset on how to earn money, right? I discovered this passive income idea or this financial freedom solution where if I had enough rental property, I could end up having more than my monthly expenses, therefore being financially free. I can go to the beach and drink Mai Tais, I can go work extra hard on my business, I can travel and spend my time how I want. Well, after I started to buy up these residential properties, maybe like you, I started to get 8, and then I got 12, and I got all the way up to 55. I quickly discovered that my property manager was stealing from me, so I completely switched my mindset over to commercial real estate. But before that though, I read another book that's actually written by the CPA of Robert Kiyosaki. His name is Tom Wheelwright. He wrote the book Tax-Free Wealth. And what he taught me and what that book is all about is that the tax law actually, and Uncle Sam is actually not out to get you. The focus of the tax law and all of that massive book is actually a list of incentives. They're trying to incentivize you to do certain things. Things like invest in oil and gas, things like investing in real estate, starting businesses. So I have up on the board here 2 different types of people in this world. You have employees, people that are W-2ers or 1099ers, and you've got employers or business owners, people that are starting businesses or investing in real estate. The biggest difference between these 2 types of people is that if they both bring in $100,000, the W-2er and the employer, what happens is Uncle Sam, you pay tax, then you have your expenses, and then whatever is left over is what you take home, right? You earn your income, you pay taxes and spend whatever's left. Well, on the other side, as a business owner, you earn your income, you pay your expenses, and then you pay tax on whatever's left. The biggest difference is that the government, again, gives subsidies and deductions to the people that are doing economic activity and creating economic output. Now, again, if you're an employee, you're not necessarily getting penalized. You just don't get the same opportunities to use the tax laws the same way that the business owner does or the investor does. So very quickly, again, just to show the math here, let's just imagine that you're in the 40% bracket the same way as the employer is. You bring $100,000 of income in, you pay 40% in taxes or $40,000, and you have 50 grand of expenses, right? Your situation might be different, could be more, could be less. But what happens is you're left over with $10,000 of net income after you run your numbers this way, which is a very typical way in your W-2 job. Every 2 weeks you see all those taxes getting withheld. On the business owner side, $100,000 of gross income, you then have those expenses that are getting to be paid out of the gross income. You're taxed at the same percentage that the employee was taxed, but you're only paying $20,000 in taxes because you have less money on paper that you earned. So you have a net income of a much larger, I guess, in return than you do if you're just working for somebody else. And that's the whole point. Because again, Uncle Sam is trying to incentivize economic activity. This employer right here, again, let's say he's in the restaurant business, he's hired multiple servers, he's hired cooks and chefs, he has maybe people that are in the staff, whatever types of businesses that they're in, he's hiring people, he's renting real estate from other investors, he's creating economic output. This person over here that's a waiter, not to say that there's nothing wrong with a waiter, but they're not creating the same economic activity or output that the business owner is. And not to mention too, this dude's taking on risk by starting a business. This dude doesn't have on any risk because if the guy fires him, well then he'll just go work at the next restaurant down the street. But let's switch gears and start talking about real estate. Because again, this stuff is cool, but let me show you the magic behind rental real estate and what there's one deduction that is above all the rest of them. I'm gonna show you here in just a second. So I wanna ask you a very simple question. This MacBook that I purchased a couple years ago, I bought it for $1,000. Do you think that this computer is worth more now or less now after I purchased it 24 months ago? Right, I mean, it's worth way less than what it was when I first purchased it because it has depreciated over time. There has been new improvements. There's been technology upgrades. Things have gone up in value, or maybe, we'll talk about inflation another time. But the point of this is that when I bought this, this was a new computer. It was the top of the line, the best thing that they had. Now, 2 years later, Mac and Apple have improved their system, their operating system. So this thing has lost value over time compared to where it is now. Now, at the end of the day, when I bought this for $1,000, now that doesn't say that I'm not losing any money elsewhere, but it's a real expense that happened to me. And so in the government or in the IRS code, I am allowed to depreciate this computer. In this case, it's over a 5-year window, but I'm able to deduct, which is on paper a phantom expense or a passive cost that maybe doesn't show me writing a check for $200 every year, but it's a real expense in business because this thing is worth less every single year compared to when I purchased it. And that's what depreciation is. It basically means that over time, your business, your tangible items in your property, whatever it is, lose value. If you own a home, the shingles on the roof, the siding on the side, even the driveway, eventually it's going to dilapidate. Things are going to crack. They're going to break down. They're going to, over time, need to be replaced. And the government recognizes that. So the way that they incentivize us as investors to go and re-up and to purchase more siding or more shingles or buy more real estate is to use this phantom expense called depreciation, which allows us to take a phantom loss or a no-cost loss to offset against the passive income of our property. Let me give you a quick example of a property that I own, and we'll walk through it. Okay, now that we understand what depreciation actually is, there's a couple different types of depreciation in real estate. You have what's called straight line depreciation and bonus depreciation. Let me explain to you what straight line is first. So I'm going to talk about commercial. Residential is a little bit different. That's 27 and a half years. Commercial real estate is over 39 years, okay? So what this means on $1 million purchase, obviously the government knows the value of the land doesn't depreciate or lose value over time because it's dirt. So you subtract the cost of the land. In this case, let's use an example of $150,000. That means the value of the property, the structure, is $850,000. Now, again, with commercial real estate, you take this number, you divide it by 39, which is, again, over 39 years. That's what the government allows. And that means you can take an annual deduction, phantom expense, a passive loss of $21,795. That's just what straight line depreciation is. Now, bonus depreciation has been around for a while, but in 2016, when President Trump passed the Jobs and Tax Cut Act, he allowed us to take bonus depreciation 100%. Now, what does that mean? What am I even talking about? So what you can do on the same thing, $1 million purchase, that minus the land, the value of the property is $850,000. What you can do is actually called a cost segregation study. Now, actually, this is my acquisition blueprint. That's step number 49 on actually how to get a deal across the finish line. If you want this thing, every single step and rung on the ladder, I'll give it to you for free. Just click the link on the bio of this episode. Okay. The cost segregation study is what that means. Wherever you're sitting right now, you're probably seeing a lamp, you're probably seeing a desk, the chair that you're sitting in. All of these items inside of your property, whether it's a house or a building, are all actually depreciating or deteriorating or losing value at a much faster rate of speed than 39 years, okay? And the government recognizes that. So what they allow you to do, a cost segregation engineer will actually come into your property. He'll itemize all of these things that are losing value at a faster rate of speed than the actual structure is. We'll group all of those items together, figure out what that total cost is, and it allows you to front load this massive cost into the very first year of your purchase. So again, each deal is a little bit unique depending upon the type of property and when it was, built and everything like that. But generally, you can use about 25% of the value of the building is what's going to come back as a total cost segregation study. So in this case, if we did a cost segregation study on this $1 million building, you're probably going to ballpark about $212,000 of passive loss. That's bonus depreciation. Now, even a couple of years ago, you could take all 100% of that in the very first year. Every year since 2022, I guess, they've stepped it down by 20%. In 2024, you can take 60% of this $212,000 number. So in this case, year one bonus depreciation of this $1 million building is going to be about $127,000. So let me just show you here how cool this can be for somebody when you buy a building like this. Again, let's say that you have a net operating income of $100,000, okay? Now, that's not unfair. That's a 10 cap. You just bought this building at a 10% cap rate based upon a $1 million purchase. What you can do with this net operating income, forget about debt service and expenses because it's a triple net lease. What you're able to do then is take $21,975 and deduct that from your net operating income. So this is your depreciation. Now, I don't know that number exactly off the top of my head. I guess it'd be 79,025 of NOI. And then, like I said in the very beginning, you are now taxed on this number. That's what your taxable income is on that building at this point. This is why I said in the very beginning, why understanding that the cash flow is not the point of real estate. It's this massive deduction. On the same exact building, the same one, look at this thing, NOI of $100,000, you now have a passive loss. You lost this money of $127,500. That means you on paper lost, no, forget again, the expenses, the debt service, everything like that. You lost on paper $27,500. So this $100,000 that's going into your pocket, you won't pay a dime of tax on. So think about this. Again, in this case, you're paying taxes on almost 80 grand. In this case, you're paying no taxes. You're going to put $100,000 in your pocket because of this phantom expense of depreciation. And that's how powerful this idea and this strategy can be. And that's why it's the hill that I'm dying on. Sure, the cash flow is great. You got to make sure the deal is bankable and the bank will lend you money on it. But if you understand the incentives, because Uncle Sam is wanting us to purchase real estate like this, they need people like us to drive economic activity. And buying $1 million buildings, I mean, think about this for a second. The bank won't have any money to lend. The insurance company won't have any property to insure. Think about it. There's no tenant that's going to be able to rent from you if it's not you, the investor, that's taking action and buying these buildings. That's why they're trying to take these massive incentives like bonus depreciation to show us that, hey, if you go and buy this building, you take on the risk of borrowing money and purchasing real estate, we'll let you keep all of this net operating income. So guys, like I said, this is one of the coolest things about purchasing and owning commercial real estate is that, not to mention that it's all triple net, the real estate and the income is passive, but you don't have to pay any taxes because of a cost segregation study and using bonus depreciation. And not to mention too, even after you take this year one bonus depreciation, you still get to depreciate the rest of this over the next 38 years. So you get to continue to use this and utilize this extra cash or this deduction every single year. So really the incentive is just to keep buying more. So if you want to learn more about commercial real estate, learn more about bonus depreciation and how you can use these to offset against your income, click the link in our bio to schedule a call with us, or just keep giving us a follow because commercial real estate is all we talk about. See you on the next video.